Hey everyone, I'm Daniel Snyder. This is Seeking Alpha. Welcome back to another great webinar. How do I know they're great? Well, we put them on. We put a lot of time into the content. So we thank you for joining us today. If you're watching the replay, thanks for watching that as well. Before we dive into everything ETFs, let's go ahead and get a quick legal disclaimer out of the way. So bear with me real fast. We are not advising you personally concerning the nature, potential value, or suitability of any particular security. You alone are solely responsible for determining whether any investment, security, or strategy, or any product or service is appropriate or suitable for you based on your investment objectives and personal and financial situation. This presentation is for information purposes only. Content is presented as of the date published or indicated and may be superseded by future events. It represents my opinions, which may not reflect the views of Seeking Alpha as a whole. It also might reflect Stephen Cress's opinions. And do not reflect the views of Seeking Alpha as a whole. Past performance is no guarantee of future results, and Seeking Alpha is not a licensed securities dealer, broker, or U.S. investment advisor or investment bank.
Well
Got it
done,
out.
Daniel.
All right, let's move on. So the man, Steve Cress, thank you so much again for your time today. Obviously, we do a lot of webinars about top these stocks, top small cap stocks, top dividend stocks, top growth stocks, AI stocks. We focus on a lot of different sectors, and we've been doing it for over a year. And I can't believe it, but we've never done one about ETFs. So I'm really excited that we get to dive into this asset class today and leverage the Seeking Alpha platform and the quant system to go deeper into ETFs that might be right for investors watching here today. So Steve, I'm gonna kick it over to you. Why don't you go ahead and tell us a little bit of background of how we got to where we are today?
Yeah, so Daniel, for those who are new to this, I have been at Seeking Alpha for almost 6 years. I have a long tenure on Wall Street. I've been in the world of finance for almost 35 years. Bulk of my career was spent at Morgan Stanley, where I worked for about 13 years. I also had a hedge fund and a fintech company that was bought by Seeking Alpha about 6 years ago. And we integrated our technology into our platform that we have today, which is a fantastic platform. And Daniel, I think really what we're well known for are our quant grades for stocks and for dividend grades on stocks as well. But what we don't really hear much about are the grades that we created for ETFs and REITs as well. And today we're going to focus on the ETFs because, as you and I both know, many people love to invest in ETFs. So a little bit about our presentation today. I'm going to go over why quant works for both. Really, I'm going to focus just on the ETFs, why we have quant for ETFs. I'm going to provide a little bit of a review on the markets from 2024 and coming into 2025. I'll be speaking on the advantages of ETFs. I'm going to tell you how our SA quant grades work on ETFs. And I'm also going to give you our top ETF picks. So without further ado, a little bit on the quant system. So for ETFs, what we look at is basically ETFs that have strong fundamentals, and we also have our powerful computer processing, and we blend both together. With our ETFs, we're looking for securities that are collectively strong on momentum, expenses, dividends, risk, liquidity, and we compare those metrics for an ETF compared to all other ETFs. So when we see those ETF grades, it gives us an instant characterization of how that ETF compares to the universe of ETFs. Now, at the same time, when we look at those data metrics, we have to load them up into a computer to rank and score all those metrics. And that's sort of part of our proprietary system at Seeking Alpha, is the ability to process all that data on a daily basis. So every day when you look at the ETF grades, and I'm going to go over our platform and show you those grades, you can be assured that those are updated on a daily basis. So every directional recommendation we have, whether it's a strong buy, hold, or sell, you know that recommendation is refreshed every day, and for that ETF against the whole universe of ETFs. So I'm going to cover a little bit about the markets. Of course, everyone is familiar with the performance that we had in the NASDAQ last year, up 23%, up 30%, I'm sorry. The S&P 500 was up about 23%, and the Dow rose about 13%. So all in all, it was a pretty good year for the markets. There was a lot of concern in the first half about what would happen with interest rates and inflation. But by the time we got to the back half of the year, investors became very comfortable that inflation was under control, and we had 3 rate decreases by the Federal Reserve. So all in all, that was the backdrop that served for a fairly positive equity market over the course of 2024. Now, coming into 2025, it would appear that for most of the second half of 2024, we thought we were going to come into a good 2025. However, December of 2024 was a pretty tricky month. And on a whole, if you looked at the median of the S&P 500, it was actually down about 6%, while the S&P 500 itself was down about 2.5%. So there's a fair amount of volatility that went into December. It carried over for about a week or so into January, but then it began to turn. And January, for the most part, looked like we were going to finish in the black. And then yesterday, we had a fairly big correction. And that correction really wasn't generated from any systemic problem with the economy. Most often, I'll talk about what could potentially be happening with tariffs and inflation and interest rates. But this actually involved an AI company out of China, and it sort of put the fear into the AI market. For the most part, this company, DeepSeek, has been able to create a version of sort of Chat GBT that is a lot less costly in terms of the power that it consumes and the data that's required. So it really sent a vibration throughout the technology sector, but also the power sector, and that really impacted the whole market yesterday. So we are sort of preparing for what could be a bit of a volatile year. And I'd like to give you some data points. The current bull market has entered its third year. And where the previous 2 years have had an average annualized return that in our bull market exceeded 20%. However, historically, bulls between the years of markets between 2.25 and 3.25 experience an average return of 4.8%. So we're far in excess of that. Between 2002 and 2021, the S&P 500 experienced declines of 10% or more in 10 out of 20 years, indicating that such a correction could occur every 2 years. So it seems like we might be due for that correction. And research shows that as a bull market approaches its third year, the likelihood of a market correction rises to 75%. Given that the current bull market is nearing its third anniversary in October of 2025, this historical pattern suggests an increased probability of a correction. And yesterday, it felt like we could have been at the beginning of it. However, the markets did recover today. There are a number of factors, though, that there still remains some uncertainty. So inflation seemed like it was under control in the second half of last year, but it seems like the Fed is not quite so certain on that. It was estimated towards the tail end of last year that there could be 3 or 4 cuts going into 2025. And now interest rate traders are really looking for maybe just 1 or 2 cuts. So there's a lot of uncertainty what's going to happen with the Fed and interest rates and inflation. However, that makes it all that much more attractive to be looking at ETFs. ETFs are very diversified. There are 7 different asset classes that you can look at. And through that diversification, a single ETF, which typically owns many, many securities, that helps to minimize your risk. So if you feel like we might be in a market that could have a correction or a pullback, or there's just a lot of uncertainty, ETFs could be a way to go for you. Last year was an incredible year for ETFs. Over 1,700 new funds were launched last year. Global ETF assets surged by more than 30%, reaching 15 trillion in total value. Worldwide ETF flows reached 1.67 trillion, with US flows accounting for 1 trillion of that. Really interesting. Daniel and I were talking about this earlier. There are 2 S&P 500s, the IVV, which is an iShares ETF that reflects the S&P 500, and a Vanguard ETF, VOO. They both brought in 200 billion in inflows in 2024. And Daniel, you really shared a great little insight with me before, because for as long as I can remember, when you thought about the S&P 500 for a passive ETF, you would usually buy SPY. And what is it that you discovered?
Yeah, so the SPY ETF, ever since I think it was 1993 when it was launched, don't quote me on that, but I'm pretty sure that's when it was. It's been the dominant leader. It's been the brand name recognition. Just like if you're talking about tissues, you talk about Kleenex, right? But now we're watching this year the spread of assets under management between SPY and all the other indexes, index ETFs that are doing the same thing. VOO, Vanguard's VOO, is actually within striking distance of surpassing SPY of assets under management for the first time in history.
Well, it's no surprise when you look at this chart on the right-hand side, you just see the tremendous growth in ETFs. People really love to invest in it. You get the lower expenses. It's sort of like set it and forget it. And especially with the passive ETFs, it's really hard for active managers to outperform these passive indexes. So it's no reason that they've been as popular as they have. So as I mentioned, there are some advantages to ETF investing. Mostly it provides investors with diversification by providing exposures to a broad range of assets with a single investment vehicle. They're also very cost effective with lower expenses, as I mentioned, compared to mutual funds. ETFs are also typically more tax efficient due to their unique structure and low turnover as well. And also, by trading on an exchange, ETFs provide investors with flexibility and liquidity. You can trade in and out of an ETF as many times as you want in one day. It's not like a mutual fund. So it gives you a great deal of flexibility in terms of trading. So at Seeking Alpha, we have a grading system that we use to determine which ETFs we prefer. As with our quant system, we have underlying factor grades that lead to that directional recommendation. For the ETFs, you can see that we have as our 5 factor grades momentum, expenses, dividends, risk, and liquidity. And as you look at the card on the right side, you can see that there are actually academic letter grades. And those letter grades give you an instant characterization on each of those factors, how that ETF compares to the universe of ETFs. And then when we dig down into our screens, you can see how it compares to its asset class or its sub asset class. And one of the things that I like about our factor card is that you not only see the current grade now versus the overall universe, but if you look at the card, you'll see that we have what it was 3 months ago and what it was 6 months ago. So it gives you an indication if that momentum, expenses, risk, or liquidity has been changing over a 6 month period. So it's a very, very powerful tool. We grade over 1,800 ETFs using these factors. So just to give you a little bit of a deeper dive on each of these core factors, momentum measures the ETF's price performance against its peers. Strong performance is a very predictive factor of a fund's returns, and it's also a strong factor for equities as well. So you'll often hear me say to individuals, just because an ETF or a stock has been strong doesn't mean that you shouldn't look at it. It's really relative to its universe or to its sector that's important. And if you could see relative to its asset class here, or the overall universe, it's really a testament to the particular ETF and what really makes its underlying assets, and the market is backing it. Another important factor is expenses. So we like to look at the expense ratio, and you can see we also look at the big bid ask percent of the spread as well. So the expenses evaluate how an ETF's expense ratio and bid ask spread ranks compared to similar funds, which is crucial as higher fees can eat into your returns over a long period of time. We also look at dividend grades. Many ETFs have dividends. The dividend grades assess the growth and consistency of an ETF's dividends, along with its yield profile, which is important information for income-seeking investors. And we also look at the risk grade. This is based on standard deviation, tracking error, and turnover to provide a holistic view of a fund's risk. And as you look at the cards on the right side, you can see for the dividend grade, we're looking at the trailing dividend yield. We're looking at a 3-year CAGR. We're looking at a 5-year CAGR. And the last 2 rows in the dividend card, you can see we look at the consecutive years of dividend growth and the consecutive years of dividend payments. So all those underlying metrics factor into the overall dividend grade. And below, you can see with the risk grade, the metrics that make that up. We look at standard deviation. We look at, in certain cases, short interest. We look at a percent of assets of top 10 holdings, annualized volatility, turnover, and tracking error for different periods. And once we assess all those, we have an overall risk grade as well. And finally, on liquidity, that's based on trading volumes in AUM, and it impacts how easily an investor can buy or sell the security. And we have 3 metrics that go into our liquidity grade, which is the overall AUM, size wins. And we also look at average daily share volume on a 3-month basis and average daily dollar value, volume on a 3-month basis. And again, when you see those grades, it gives you an instant characterization how it compares to all other ETFs. So we look at 7 different ETF asset classes. We like to provide diversification. And as you can see, this is in line with what we do traditionally on our quant system. When we look at the ETFs, we lead off with allocation ETFs, which typically provide exposure to a predetermined blend of asset classes, which helps investors balance growth and risk. We look at alternative ETFs, which are non traditional strategies such as hedge fund strategies or crypto strategies, long or short. These are asset classes that are less correlated to the equity markets. We look at commodity ETFs, which invest in physical assets like gold, or a hedge against inflation. We also put currencies within that as well. There are international equity ETFs, and that's basically non-US securities, and that can be broken down by region or specific countries. We look at sector equity ETFs, which target specific sectors or industries such as consumer discretionary or consumer staples, or as specific as semiconductors or automotive. We have taxable bond ETFs, and those are fixed income ETFs, which typically are focused for individuals looking for income or to help balance out portfolio risk. And there are US equity ETFs. These ETFs typically track major US stock indices, but can also include any ETF offering broad exposure to the US market. So
Hey,
those are
Steve,
yeah.
quick, if I might add right here. So obviously we're talking about ETFs today, and I'm not sure if you're aware, but Seeking Alpha, as of this morning, just launched its brand new ETF Spotlight video series. And there's 6 episodes that launched today. We highly encourage everybody to go check it out. I'm asked the team in the back right now, actually, if you'll drop the link in the chat, and we'll put it underneath the replay as well. But all of these categories, all of these asset classes, Seeking Alpha and the video team here are diving deeper into them. We're talking to Seeking Alpha analysts, we're talking to investing group leaders, we're talking to the fund issuers and fund managers themselves. And we have some really awesome episodes with like ARK Invest that just launched today. And we talked to Brad Thomas from iRead about real estate ETFs. We have people coming up like Charles Schwab. I don't know, maybe you've heard of the ETF SCHD. Well, they're on our radar, and it's coming in the weeks ahead. So I would encourage everybody to go check out that content. And just wanted to do a little shameless plug right there. Hope you don't mind, but we will.
I'm glad you did, because what we're doing just skims the surface in terms of our ETF offering at Seeking Alpha. So Daniel, thank you so much for bringing that up.
All
I
right.
really appreciate
Let
it.
me get out of the way. Let's dive back
All
in.
right,
Top
let's
7
do it. The top 7 ETFs across asset classes right now. So again, we're not picking all the top rank ETFs. What we wanted to do is provide some diversification. So we're selecting top ETFs in each asset class. So leading off, you'll see the ticker symbol on the far left side, the name of the ETF, and then it'll say sector. It's really the asset class there. So our first pick for the alternative asset class is ticker symbol IBIT. It's the iShare Bitcoin Trust ETF. And you can see that has the highest quant rating at 4.96. You'll see all these, a common thread is a very strong momentum that they have. And really, momentum is a key factor that we look at, whether it be stocks or ETFs. And you can see almost this is like an A report card here. Basically, we have 5 A pluses and 2 A's. You can see in terms of the ETF expenses, not quite as strong in terms of all the A's. Some actually come in the D plus category, but those ETFs do have very strong momentum. You can see with the Bitcoin, this one doesn't have dividends, so you don't see a grade there. As you'll find with the iShares Gold Trust Micro, that doesn't have dividends either, so there will be no grade for that. And then you see the risk category and the liquidity category. So I'd say really 2 strong factors are both momentum and liquidity that you see for these. The number 2 is the Vitrus Reeves Utilities ETFs. That's the sector equity. So I bet that's going to take a lot of people by surprise that we actually have a utility ETF representing the sectors. For the international equity, we have the Argentina ETF. For the US equity, we have the TCW Transform System ETF. For commodities, this might not surprise anybody. We have the iShares Gold Trust Micro ETF. For a taxable bond, this is a simply interest rate hedge. So this is a little bit different for a taxable bond, but this has our highest quant rating for taxable bonds. And then for allocation, we have the Van Eck Real Assets ETF. So those are our top ETFs for those asset classes. We're going to take a little bit of a deeper dive So the Bitcoin ETF, again, ticker symbol IBIT. If you look at the card to the right side, you can see the actual ETF grades, and you can see momentum comes in with an A plus, expenses A, risk on the D plus side, and that's probably no surprise because Bitcoin in itself can be highly volatile and fairly risky, but it is extremely liquid. So very strong ETF grades there. Of course, it's got a strong buy in the sub asset class, which is digital assets. It ranks number 2 out of 46. So I'm actually going to take us to our platform, Daniel, and I'm going to take us right into the Seeking Alpha platform. And you can actually see the 1-year history. This ETF is up 133%. Again, it has on the far right side of the rating summary, you'll see it has a quant strong buy, but it looks like our Seeking Alpha contributors have a buy on this as well, with the ETF grades right underneath. And if I were to click on momentum, you could actually see it's an A plus report card for all the various time periods. So whether we're looking at a 1-year time period, 6-month period, or a 1-month period, it has completely crushed all the other ETFs that are out there. So very, very strong in terms of momentum. And I'm going to take us down a little bit further, and you can see where it ranks in its subclass. And at any time, if you want to check out other ETFs in the digital asset class, you could just click on it. So you can click either on this 4 out of 46 or on digital assets. And you can see all the other digital asset ETFs that are out there. So you really can have a wide choice. It doesn't have to really revolve around the one that we're highlighted today. You can take a look at all the different choices that are there. Going to bring us back to our presentation. Down to the next one, which is the Virtus Reeves Utilities ETF, ticker symbol UTES. This has about 405 million under management, and within its subclass of utilities, it ranks number 1 out of 12. Its expense ratio at 0.49, sort of middle of the group. You can see that expense ratio is a C plus, which it's had over the last 6 months as well. So that really puts it almost dead center of the ETF group overall. It's an actively managed fund, so this is not a passive one. This is an actively managed ETF targeting the utilities sector. And you can see it's had recent performance has been fairly strong. I'm going to take us into the platform again. And you can see over the year, it's up 51%. Year to date, though, it's up 2.95%. But in the last 5 days, you can see it's had a major pullback. And that is really from what we experienced yesterday in the markets. Again, of course, the company out of China showing that it could do basically AI for cheaper and faster and requiring a lot less power. And our utility sector has really moved significantly over the last 52 weeks because of the demand and power from the data centers, which of course is related to AI. So when news broke of this company yesterday, which required chips that didn't need nearly as much power, it hit the sector, the utility sector here in the US. But I think that's going to be very short-lived because it's just, one single company at this point out of China. Of course, we always have technologies that are improving and becoming more efficient. But whenever technology or any natural resource and the mechanics of manufacturing that surrounds it becomes more efficient, it typically becomes more widely used. So, I think we're really at the infancy of the AI era, and costs might become cheaper, but usage could go up. Taking us back to our slideshow. On to the next ETF, we have the Global X MSCI Argentina ETF. So Argentina has been a great performer over the last 52 weeks. Of course, this subclass is the miscellaneous regional. It ranks 1 out of 57. Its expense ratio a little bit on the higher side at 0.59, but you'll often find that with some country ETFs. This particular ETF invests in 28 of Argentina's largest and most liquid companies. As I mentioned earlier, Argentina is sort of in the midst of a recovery coming off of recessions from the first half of 2024. There was government intervention, a lot of change in economic reforms, political, monetary, fiscal policy, all to sort of help generate growth in Argentina. and it had worked out very, very well for Argentina, especially in the second half of last year. So as you can see, Argentina's um, passive ETF performing very, very well. Number four, we have the TCW Transform System ETF, ticker symbol NETZ. This currently has close to 400 million in AUM, and its subclass, which is a large blend, it ranks 1 out of 194. The expense ratio comes in at 0.44, which compared to the US equity large blend is actually fairly expensive. This ETF focuses on energy, technology, and utilities, really all the right sectors for 2024. And I think a lot of investors are banking that those sectors will continue to work in 2025. Again, as I mentioned, AI really at its infancy and such huge demand from the data centers in terms of energy. This brings us to our next ETF, which is the iShares Gold Trust Micro ETF, ticker symbol IAUM. This is significantly larger at 1.46 billion. This has a quant buy on it, not a strong buy. The rating on this is actually a quant buy. However, for its subclass in commodities focus, it does rank 1 out of 41. Expense ratio very low here, coming in at 0.09, hence the A grade. Again, giving you that instant characterization for how the expenses compare to all the others. This particular ETF is backed by physical gold bars that is held in vaults, and it provides investors with a simple and efficient way to invest in gold without having to own the physical asset. Bringing us to number 6 is the Simply Interest Rate Hedge, ticker symbol PFIX. This is rather small at 193 million and very, very volatile. It is interest rate sensitive. And you can almost sort of just see when we look at that quant rating history of how many times it's gone into sell territory, which has often worked out well, and coming into buy territory recently. I'm actually going to pull this up, PFIX. So I'm going to take us to our platform. And you can see in terms of its momentum grade, it is an A minus now. Its expenses are a C. The dividends are an A plus. It actually has a dividend yield of 3.36%, which is a nice dividend yield. It is risky, which you can tell just by looking how that stock price goes back and forth. And you might not really expect this for a taxable bond asset class, but this is an inflation protected bond. And, we were coming off a period last year where inflation in the first half was a concern, but in the second half, it wasn't. And when you look at the price chart, you could almost see really when we got to May, the concerns were basically would interest rates be going up? Would inflation be sticky? So from May of 2024 all the way through September, you could see the price of this declined. However, as the market became more convinced that interest rates would be declining and inflation would be under control, you could see that this really turned around and started to appreciate. So it sort of brings us to a period in time right now where the Fed is basically going to have to wait to see what kind of data comes in. Inflation tends to be stickier. And if we do have tariffs taking place in the new administration, historically, tariffs do lead to inflation. So this could be some fairly good protection to own. So it may not be the typical taxable bond, but being that there is uncertainty with inflation, this could be a good asset to own. And again, with the ETFs, you really want diversification, and having an inflation hedge might not be a bad idea right now. Taking us to our next slide. Our number 7 pick is the Van Eck Real Assets ETF. Again, this is a smaller ETF with assets of only 103 million. Again, this is a buy rated in its asset class, which is the asset allocation asset class. It ranks number 1 out of 79. And for this particular ETF, they have an allocation which is 50 to 70% equity. It currently ranks 1 out of 15. Its expense ratio is definitely on the higher side at 0.77. But when you look at the grades, you can see its momentum has been fairly strong. And the momentum now is an A minus. 6 months ago, it was B minus. So the momentum continues in this. And I'm going to take us back to the platform for RAAX. And we're going to go to the summary page, and we'll go back to the ratings. So you can see over the last year, it's up about 14%. Again, you're seeing some raid with the factor grades for expenses and dividends. It really does not, its yield is 1.85%. So it's a little bit better than the S&P 500. Um, but you could see, obviously, it's focused on diversification by its sub asset class, and it's currently ranking 1 out of 15. If you click on that allocation, which is 50 to 70% equity, you can see other ETFs which are similar. And when you look at this, you'll see within this asset class, it's the only one rated buy. The others have holds, and most of the others have sells. And it's probably no surprise because this has been a tough place to make money over the last couple of years. The traditional 60/40 model, as people often refer to it, has not really performed well post the pandemic. However, coming into a period where interest rates should be declining or could be declining, this asset class should do a little bit better. Taking us back to uh, the summary page for it. Again, you can see over the last 52 weeks its performance, but you can also find that there are articles from our contributors, which are fairly mixed from buy, hold, and sell, and a lot of news on it as well. If you dive into the underlying metrics, you can see the momentum is very strong, really going back even over a 5-year period. The total return compared to similar ETFs has been very, very strong. The 3-year return is strong, 1-year return is strong, 6-month return, and the 1-month return has been very, very strong compared to the median for all ETFs. So I'm going to take us back to our presentation, Daniel. And we are coming out with an article. So we really sort of skimmed the surface today in terms of these 7 ETFs. Tomorrow morning at 5 a.m., I will be publishing an article which takes a deeper dive. And if you're interested in ETFs or our quant system overall, when you're on the article, please feel free to click on follow, and you'll receive most of the articles that I write, whether it's on stocks or REITs or ETFs. So, Dale, ETFs, they're a product that's a little bit easier than equities. As I mentioned early on, it's sort of a set it and forget it approach. So many investors that come to our site, though, they want more than ETFs. They want stocks and they want ETFs. About 2.5 years ago, I developed a product to sort of help bring my strong buy ideas forward. The product that I'm discussing is Alpha Picks. So I designed Alpha Picks for long-term investors that just want to have sort of a fair flow of ideas. Um, with Alpha Picks, we provide 2 strong buy ideas every month. And this does not invest in ETFs. This actually just invests in stocks. And we don't invest in REITs either. It's actually 10 out of the 11 GIC sectors. But we do have a fairly successful track record with quant overall. And we wanted to develop a system where it sort of helped individuals that don't want a high frequency of ideas. So if you like ETFs, but you want to have some securities as well, without being inundated with thousands and thousands of recommendations, this could be a good product for you. And we have a fairly good history. It brings forward our 2 strong buy quant recommendations, 2 of our strongest buy quant recommendations every month. As I mentioned, we started about 2.5 years ago, and you can see since its inception, it's up 185% versus the S&P, which is up 61%. But even taking a look at a spectrum of return periods, you can see over the last 52 weeks, Alpha Pix is up 56% versus the S&P up 25%. Over a 3-month period, it's up 14% versus the S&P up 4.93%. And even year to date, which, we're just into the first month of the year at this point, only in January, Alpha Pix is up an amazing 10% versus the S&P up about 3.71% for the same period. So for individuals that sort of like a long-term approach, you'd like to have ETFs, but you'd like to have a few equities as well, Alpha Pix could actually be a fairly good product for you to take a look at to help supplement your ETF investments. And that sort of brings us to the end of the presentation. We do have another webinar coming up, Daniel. You might want to share some details on
Yeah,
that.
let me dive in here. So obviously, a lot of people care about dividends, whether it's through an ETF, getting that yield from an ETF, or from individual stocks or preferreds, or there's so many different ways to gather dividends for fixed income. So we want to highly encourage everyone, put March 5th on your calendars. Seeking Alpha will be hosting its digital dividend investing forum. So we're going to have a mix of speakers, investing group leaders. We're going to be doing everything fixed income. So please put that on your calendar. Tune in. You're not going to want to miss it. Steve, one other thing I want to correct real quick, just to make sure we clarify.
Yep.
As we were going through, I believe I saw a typo on one of the slides. So the NETZ ETF we talked about today, that was the Transform Systems ETF. Expense ratio is actually 75 basis points. I think we had 44 basis points here on the screen. So I just want to
Ah,
make sure we clarify that for everybody watching.
all
And
right.
actually, we
I'm
have
glad you highlighted that. So what we'll do is we'll go back to the platform, NETZ, and we can really check that really super fast.
yeah. So I just want to make sure we clarify that. You can get all of this data here on Seeking
And
Alpha.
boom, one click away, Daniel. And
Yeah.
there it is.
There you go.
Okay.
And then also, I encourage everybody to follow the ETF symbols here on the site as well. Or if you're like me, I like to put them in a portfolio and keep track of them personally, but that's just how I like to do it.
And, Daniel, I saw a question, how do we select some of these ETFs? And of course, I should have covered that. I want to highlight, since we're on the platform, if you look at the left-hand section and you scroll all the way down, you work your way past all of the separate portfolios that I have. Daniel likes portfolios. I really like portfolios. These are all portfolios over here. But if you want to find ETFs, we have a great screener. You simply click on ETF screener, and we have a bunch of pre-baked ones. You could look at all ETFs, and I'll click on that. And this ranks them all by their quant rating. So you can see it's really concentrated right now with a lot of the Bitcoin and crypto currency ETFs at the very, very top. However, you don't have to look at all of them. You could actually look at top allocation ETFs, top alternative ETFs, top commodities. So I'll click on that. So if you're very focused on one particular asset class, you could actually come to our platform and look at just this asset class. So this is commodities. And as we highlighted in the presentation, our top pick was the Gold Trust Micro ETF, but you can see the other ones that are underneath it. And again, fairly correlated for this asset class. Gold has been doing particularly well. When you scroll down, you'll see it gets into some other precious metals and silver and oil. So it does cover the gamut. If we back up a page here, we could take a look at taxable ETFs. And we have to, let's see, X out of that. And this will give a broader range of the taxable ETFs that are there. Nope. Sorry, Daniel. I think I clicked on the wrong thing. But I think, as I said, if you go to advanced filters, there are a whole bunch of different choices that you can pick in terms of how you want to look at these for the ratings, the performance, the holdings. You can cancel out of that. And of course, you could go into it, as I mentioned, by looking at the different asset classes as well. So this is a great way to pick ETFs, is just by using our screener. So
Yeah. Steve, while you're on the platform, actually, I
yeah.
throw a little curveball at you here. So there's a question that came in of what are your thoughts on the VTI ETF? Maybe we just go ahead and pull that one up in real time and kind of showcase the data we have about Vanguard's fund here.
Okay, so this is the Vanguard Total Stock Market Index ETF. As Daniel said, ticker symbol VTI, currently trading at $299.65. As you go to the right-hand side and you review the quant section, you can see we have the quant rating, which is a buy on it, and the SA contributors, which have a hold on it. But as we look at the underlying metrics, this is really a nice report card. Momentum is a B plus. Expenses A plus. So let's click on expenses there and see. Wow, that's just, it doesn't get much lower than that. You'd have
So
to basically
that's
be
the
for
Bogle
free.
effect right there, 3 basis points.
And that's probably, let's compare that to SPY. So if we put in SPY, oops, SPY,
Should be about 9 basis points, I believe.
and it's 9 basis points. Yeah. So 9 versus the 3.
Still
And
not
that's,
horrible, right? But a difference of 6 basis points back in my own pocket. I would take VOO versus SPY. Just
yeah,
saying.
especially if you're just doing it, year in and year out over a long term, that's going to compound for you. So they're investing in the same thing. So you might as well go with the lower cost product.
Exactly. All right, Steve, let's jump into a few more of these questions over here. So we had a question come in. It says, at what time are the the grades from the quant system, when are those updated? What time every day?
Every morning, basically starting at around 3 a.m. to, roughly before 6 a.m. Eastern Standard Time. That's for all our ETFs and for all our stocks as well.
And that's every trading day, right?
Every trading day. Every
Okay.
trading day.
Every day the market's open. There we go. Sometimes it seems like an ETF rating is lower than the sum/average ratings of the individual stocks that make it up. Any explanation? This is a good question about ETFs in general. You want to take that one?
Yeah. Just rephrase that one more time, Daniel.
Yeah, so somebody's wondering, so ETFs being the basket of stocks they are, the stocks
Right.
might be weighted, a strong buy, and then ETF might be rated a buy because of the diversification factor there. So I think it's just kind of a question of why might there be a little bit of difference in ratings based off of the stocks that make up the entire basket, the ETF.
Yeah. So in order to see that, so like if you wanted to the Vanguard total stock market index, you would have to load up all the stocks to see what the underlying metrics are. And I actually have that, not for the Vanguard, but for the SPY. And I've loaded this up into the portfolio tool so you can actually see what the ratings are. And here's the quant. So you can see there's a number of straw buys in the S&P 500, but then as you scroll down, you can see the buys, the holds, and the sells. So I think what Daniel's referring to is if you looked at some of the underlying ones and you sort of added those all up, it might be a strong buy, why the ETF itself could be a buy. And the reason is, remember, it's relative to the other ETFs that are out there. So when we look at the equities, for each stock, it's relative to the stocks in its sector. When we're looking at the ETF score, it's relative to the other ETFs. And we're looking at some different metrics. We have expense ratio, we have liquidity, we have risk. So since those scores could weigh differently when you're comparing the ETF to other ETFs, it could change that rating. But I think it'd probably be pretty rare. If you had mostly strong buy equities in it, it would probably most often be a strong buy for the ETF itself, unless the expense ratio was like absurdly high. And then it's a good call.
Yeah. Want to go ahead and clarify real quick. This question comes up all the time about Alpha Picks. They say, Steve, have you made an Alpha Picks ETF? There is not at this moment in time. There's not an ETF that encompasses the entire Alpha Picks portfolio, but we do see that question come in a lot. So I wanted to go ahead and address that. But Steve, a question for you about Alpha Picks is, will ETFs be ever included in the Alpha Picks portfolio?
Not in the Alpha Picks portfolio. There might be some point in time where we create a new product that has ETFs in it. Such as we're sort of recommending 7 ETFs today for each asset class. But Alpha Picks is specifically going to be for stocks, and it actually doesn't even include REITs in it. So, real estate is a gig sector, but we have separate grades for REITs, so that's why we don't include it with our other securities.
Awesome. There's a question here about, the way we always hear it phrased is, are we missing the boat? Maybe you can take a second. The question was specifically, have we missed the run of Argentina, right? We mentioned the Argentina ETF today in the presentation. People are always fearful that they miss the move. Maybe you can touch on what grade here tells us that the move may not be over yet.
Yeah, so we're gonna pull that one up. I just want to ARGT. Okay, so whenever you see a momentum grade like this, of A plus, I'm going to click on it. So, for a 5-year period, it's kind of interesting. I mean, one of the reasons why it did well over the last year is because it was coming out of a recession. Over the last 1 month, it has not performed as well as some of the other ETFs have, but you can't really use 1 month to judge it. Um, I would say, it's a very impressive country in terms of its returns. If you look at a 5-year period and a 3-year period, it's really crushed all the other ETFs. And even if I want to go to SPY, and we're going to pull that up on another page. So I want you to keep that 5-year return there, and we're going to do SPY summary. So the S&P 500 is up 83% over a 5-year period, and Argentina is up 258%. And over a 3-year period, it's just impressive. And, you don't have, Argentina leading with technology companies. You don't have the Mag 7, okay? So, what they're doing in terms of the reforms in the country, and many of the companies that are located there, seem to be very efficient, have good balance sheets, have good income statements that are standing up on their own right without being concentrated in the technology sector. So, I would have a little bit of faith in these, momentum grades, and that it would continue. But you can also go to the summary page, and you can find people who really focus on Argentina, or maybe our country experts, and you can see there are a lot of buys for Argentina. In the last couple months since November, there's two articles in November, one article in December, one article recently as well, and you can see the essay contributors. The consensus is buy on it as well. So you don't only have to take it for quant. You could look at what the contributors have to say as well. But the momentum for this for a long period of time, it has been very strong.
Steve, I'm going to mention as well. Last week, I just had a webinar with Chris Demuth Jr. He's the investing group leader for Sifting the World, hedge fund manager, right? He was telling me the same thing, that he is fully into Argentina. He likes what's going on there. He sees opportunities in our market to benefit off of that as well. And he actually shared a trade that he's doing to hopefully ride a nice return based off of that. So you're not alone in this from the quant perspective to other people that are in the space as well. Everybody seems to be rallying behind Argentina for sure.
Yeah, and you can see like the most recent news headline, Argentina emerges from recession and huge win for their president. So it shows that they can have a pretty immediate effect on the economy. If it's not doing well, they take the right steps, they implement the right reforms, and they were rewarded for it.
Absolutely. All right, Steve, this has been a pleasant presentation to be a part of today. Obviously, you come every day to these webinars with just the buttoned up deck that helps us, and you dive into the platform, which helps us learn how to navigate Seeking Alpha a little bit better. But we're going to go ahead and jump out of here. Is there anything you would like to share before we go?
I just want to thank you for pulling this together. As you always do, you picked up great topics, and this is something we haven't covered in the past, and we probably should have, and we need to continue to do it because our ETF grades work very well. So I'm thrilled that you brought us together today for this experience.
Yeah, that's a great point. I mean, the inflows to the ETF space, if last year was any sort of guiding North Star, is that this year might be even better. So definitely an asset class we should keep an eye on. So
Yeah, look for that diversification which ETFs provide. So it's been a good bull run for the last couple of years. As I mentioned with that one data point, we're coming into our third year at October of 2025. You usually do get a bit of a pullback. So if you know that, if you think that might be coming, diversification is a great way to do it, and ETFs is a magnificent way to achieve diversification.
you heard it here first. All right, everyone. Thank you for joining today's webinar. If you watch the replay, we appreciate it as well. Don't forget to check out Alpha Picks. Check out our dividend forum coming up on March 5th, as well as ETF Spotlight found on Seeking Alpha in the video hub. You can go to seekingalpha.com/videos to find that. And we'll see you here in the next webinar. Take care.
Thank you.